Greetings to everyone. Here I wanted us to discuss about accounting equation of a financial position of the business. Accounting equation, as we all know, it's all about the financial position of the business and also a financial performance of a business. Yeah, and then today I wanted us to look both financial performance and also financial position of the business. Accounting equation is helping us to understand the working of accounting before we can calculate or we can answer any question that is based on transactions, adjustments, and we record transaction, we post transaction into the required ledgers. Then we need to know and understand better the thing that is called accounting equation. Okay, now we've got accounting equation of a financial position. Accounting equation for financial position. Okay, let's start with financial position, guys. And then the financial position is whereby we are looking for our assets, or we are studying about our assets of the business equals to owner's equity owner's equities plus liabilities. This is accounting equation for a financial what position. And then based on this one, as far as I know, you can't understand the whole accounting equation while you don't understand what are the assets, what are the owner's equity, and also liabilities. Now, assets are the resources controlled by the business. Therefore, when we are studying about assets, we are looking for the things that controlled by what? The business. So all assets are the resources, isn't inside of the business, but they controlled by what? The business. They never controlled by the owner, but they controlled by what? By the business. Okay, there are two types of assets. We have non-current assets and also a current assets. We've got non-current assets as well as a current assets. These are two types of assets. Now, the non-current assets are the assets that can be converted into cash beyond 1 year or over 1 year. They beyond 1 year. Remember, 1 year is 12 months, ne? So you can make cash with non-current assets over 1 year. Maybe it can be converted after 5 years, after 10 years, or even after 20 years. But when we are studying about a current asset, now we can talk. Current assets can be converted into money within 1 year. So this one is within 1 year or 12 months. Okay, those are current what? Assets. And then now the question is, what types of non-current assets? What types of current assets? Okay, let's look firstly the types of non-current assets. Okay, types of non-current assets. Non-current assets, we have vehicles, we have equipment, we have land and building. have fixed deposit. Okay, these are the types of non-current assets. Vehicles are the cars, motors, are the trucks that used to transport goods and services from one place to another. So in the business we use vehicles to transport our goods and services. Automatically it will spend a lot of years inside of the business for us to make what a profit or to make an income using those vehicles, ne? Okay, I've said to you are the trucks, maybe vans, and more and more and more. Okay, and then about equipment, we can mention laptops or computers. We can mention everything that is all up that is inside of administration or offices of directors and more inside of the business. So those things are called what? Equipment. And then we have a land and building. A land and building is a building where the business is operating, and also a land. A fixed deposit is the money that have been deposited in the bank, maybe for 10 years, 20 years, or even more, with the aim of getting what? The interest. So these are the types of non-current what? Assets. Okay, now let's look the types of current assets. Let's quickly look the types of current assets. Okay, now we look the current types of current assets. Okay, now types of current assets. Firstly, you have bank, we have trading stock or inventory or inventory. We have trade receivable or debtors control. We have these are the types of current what? Current assets. Types of current assets: bank, trading stock or inventory, and trade receivable or debtors control. Obviously a bank is a bank account of a business, so a bank account of the business is current because you can get money anytime. So as well as a trading stock. Trading stock are the items bought by the business in order to resell them to their customers. And then a trade receivables or debtors control are people who owe business money. So it's happening that the business is selling goods and services on credit. So those people who are owing a business that money, they will be called what? Debtors or debtors control. So here under current assets, we call them the trade receivable, the things that we are expecting to receive in future, or money, as well as we can call them the debtors what? Control. So these are the types of current assets. Okay, now we have done about assets, guys. I've taught you about types of current assets, non-current assets, and now we know what is a non-current asset, what is a current assets. Non-current assets are the resources that can be used to convert into money beyond 1 year. That is a non-current assets. But current assets are the resources that can be used to convert into money within 1 year. All right, now let's look at the effects of this accounting equation that is affected by the transactions. But before we can look that, we have a T accounts, but we are going to learn more about a T account when we are doing in this lesson. We will do the double entry principle, so we will learn more about a T account. Okay, but I want to show you something here. We have a T account of assets. Here is we have what, a credit side. Here we have what, a debit side. Okay, I want us to learn now all assets, whether it's a non-current assets or it's a current assets, they increase on debit side but decrease on credit side. All types of assets, they increase on the debit side but decrease on the credit side. All types of what? Of assets. So therefore, if there is a type of asset which is a bank, maybe the question says you need to open the T account of a bank. We have a credit side, we have a debit side. So this T account will automatically increase on a debit side, decrease on a credit side, because is a type of what? Of asset. Even a vehicle is a type of asset, as we mentioned earlier. It will increase on debit side, decrease credit side. All types of assets increase on a debit side, decrease on a credit side. So this is very, very important for you to know. Yeah. Okay, let's move on now by looking the owner's equity. Now, owner's equity is the interest of the owner. Owner's equity is the interest of the owner. So when we are talking about owner's equity, is all about the interest of the owner. Remember, when you want to start a business, you need a capital, and then at the end of the year or every year, you are expecting to get a profit or income from your business because you have invested your money. Capital is the man to start a business, so is the investment of the owner to his or her business. So at the end of each year, you will be expecting what? To get a profit of what you have invested in your own business. So in other words, here we are studying more about the things that belongs to the owner. Therefore, owner's equity are controlled by the owner, are the interest of the owner. So what types of owner's equity are they? We have income, we have expenses, we have capital, we have drawings. Okay, these are the types of owner's equity that we need to understand as we understand ourselves, so that all things will be easier for us to master. Okay, now incomes, it's include the all income that the business have made, such as sales, Okay, sales is the return from what we have sold into our customers, ne? And then there is a rent income, if it's possible. Rent income, maybe when a business owner took a portion of the business, portion of the building of the business, and gave it to its tenant, and then those people will pay the rent at the end of each month. Okay, and then expenses, we've got what? Water and electricity, we've got salaries and wages, we've got telephone expenses, we've got what? The cost of sales. Everything that we need to pay for. Okay, now all expenses, they cause the outflow of money from the business. So it's called the outflow of money from what? From the business. So we need to pay for water and electricity, we need to pay for telephone expenses, we need to pay for salaries and wages, we need to pay for cost of sales. And then we move on to a capital. I've said to you, a capital is the investment of the owner, or is the money to start the business. So this one is invested by the owner to their business. And then we move on to the last one, the drawings. Drawings is a process whereby the owner take assets or anything from the business for his or her personal use, whether it's a cash or it's a trading stock or anything from the business for his or her personal use. So we call it what? Drawings. Okay, now we understand all types of owner's equity. We understand all types of owner's equity. Okay, let's move on by looking the liabilities. Let's look at my liabilities now. Okay, now we look at my liabilities. Alright, and then liabilities are the debts of the business. Liabilities are the debts of the business. So when we are talking about the liabilities, we're talking about the debts of the business. So liabilities are different into non-current, or differentiated into non-current liabilities and also a current liabilities. We have non-current liabilities as well as a current what? Liabilities. Now a non-current liabilities are the debts that can be settled beyond 1 year or over 1 year. Maybe it can be a debt of 5 years. Maybe a business decided to borrow money that will take 5 years to pay for it. 5 years or even 10 years. So it is depending of that particular loan or anything. So here our current liabilities are those liabilities that can be settled or that can be paid off within 1 year. So any debts that can be paid off within 1 year, it will be called a current liabilities. Okay, now let's look the types of non-current liabilities. We have what? A long term loans and also a mortgage bonds. Yeah, okay, these are the non-current liabilities: long-term loan and also mortgage bonds. Yeah, so a business can borrow money from any financial provider or from a business, so we call it what? a long-term loan. Only if it's over than 1 year, maybe 5 years, 10 years, or even more. Okay, and then mortgage bonds is the loan that can be taken by the owner or by the business in order to fund what the land and building. Maybe you need a land and building. The loan that can be taken or that is applicable is what is a mortgage bond. Okay, and then the types of, now let's look types of current liabilities. Types of current liabilities. First, we have what? A creditors. We have creditors. Secondly, bank overdraft. Bank overdraft. Secondly, short term loan. Lesibiza kuthiwa yini? It's a current portion. Short term loan or current portion of a non-current liabilities. Okay, then this is another current liability. Alright, these are types of current liabilities, guys. Then the creditors are people who owed by a business. So a business can buy goods and services on credit, can buy goods and services on credit from their suppliers. So those people the business owed money to, they will be called what? A creditors. And then a bank overdraft, it is whereby a business is over withdrawing money from its bank. And then the current or the short-term loan, which is a current portion of non-current liabilities, it should be when a business borrow money and then they will repay for it within 1 year. Maybe it can be 6 months. So that's why we call it what? A current liabilities. Okay, now we can understand, or we understand types of owner's equity and also types of liabilities. Okay, let's look now the effect of both owner's equity and also liabilities. Let's look the effect of owner's equity and liabilities. Remember, we have said assets are increasing on the debit side but decreasing on the credit side. Now let's look owner's equity and liabilities. Here is a T account of owner's equity, T account of liabilities. Let me write owner's equity is credit side, debit side, liabilities, credit side as well as a debit side. Okay, all owner's equity are increasing on a credit side. They increase on the credit side, decrease on debit side. All liabilities increase on the credit side, decrease on the debit side. So both owner's equity and also liabilities, they increase on the credit side but decrease on the debit side. So all types of liabilities, all types of owner's equity increase on the credit side but decrease on a debit what side. Okay, for example, if I'm taking water and electricity, maybe there is account of water and electricity on our credit side, debit side. So it must increase on credit side, decrease on a debit side, because this is a type. Okay, I'm sorry. Okay, let me take an example of income. An income, maybe sales. Okay, credit side and also a debit side. It must increase on the debit side and also credit side. Okay, guys, in our another lesson, let's end here for now. In our next lesson, I will teach you about the ET account of asset and also liabilities, whereby we are looking the effect from what, from the double entry principle. For now, let's end here. If you need more classes and also assignments assistance in accounting, FAC 1501, FAC 1502, FAC 1503, FAC 1601, FAC 1602, and also taxation, BNU, and also QMI, you can contact me. I'm here to teach you and assist you with assignments. Thank you so much. Have a nice